Jack Bogle Project 2, this is part 2. And this is some general stock information. Well, first of all, large cap, mid cap, small cap. This is so someday if you have a 401k provided by your employer, a control panel will come up on a page of your computer, a web page. You'll have to select what types of funds to invest your money in. If you're somewhat literate, it won't be so intimidating. You won't just choose like throwing a dart at a dartboard. So, large cap, mid cap, small cap. You can invest in a fund that's entirely large cap, entirely mid cap, entirely small cap, if you like. And some people like to do that, depending on where the market is and what they perceive is going to happen. Large cap is market capitalization of greater than 10 billion. Now, market capitalization is just another name for how much their stock is worth. Capital is another name for money. If the sum total of their stock is worth more than 10 billion, it's a large cap. Less than 2 billion is a small cap. In between is mid cap. Large cap stocks sometimes don't have quite the potential for growth. You know, you think Ford, General Motors are pretty big. They pretty much have most of the market they're going to have. Small cap can be a little more risky, more potential for growth. Like Tesla, for instance, when it started off, was probably a small cap stock, and look where it is now. Microsoft was a small cap stock in the beginning, way back in the 80s, and look where it is now. If you can invest in a small cap, it's a winner over a long period of time. They start with a small market share. Next thing you know, they have the whole market, and then they move into other markets. Index versus managed. We mentioned that before. Here the fee is about 0.2%, 0.75 to 1%. If you have, quite often you'll have a choice. You may have large cap stock, managed or index. You can choose the index that's cheaper. Sometimes you have a choice. I also mentioned difficult to catch up at age 50. And it isn't as though from age 50 to 60 you're going to accumulate half the funds you would from age 40 to 60. You not only have only 10 years, but you have a shorter amount of time for the money to accumulate in the stock market. The money you invest from 20 to 30 is worth a lot more than money you invest from 50 to 60. So start early. It's difficult for young people to conceive of this, especially since you haven't really worked. The time to think about retirement is right when you start working, actually. Another term is value stocks versus growth stocks. Value stocks are generally undervalued by some common measures that are used to measure value. I'm not going to get into that. Undervalued. For instance, suppose you could buy a business for $1,000 and every year it returned $1,000. Basically, it's returning 100% on your money. That's undervalued. You got a great deal. If based on what the company's returning, you're getting a great deal, it's probably undervalued based on the current market conditions. And that's currently what's happening. Growth stocks, generally they reinvest all their dividends. Normally a stock, if you're a stockholder in a company, the company does all their business. At the end of the year, they have some profits. What do? They send it out to the people that own the company. Those are called dividends. Growth stock companies generally reinvest the dividends. They don't pay you any kind of income. And how do they reinvest it? Well, they buy new equipment. They try to grow their market share in whatever they're selling, move into other markets. They're generally poised for the future. Google's a growth stock, Amazon's a growth stock. They're always reinvesting. And that's why we see Amazon trucks everywhere now. Whole Foods is owned by Amazon. Now Amazon has their own shipping company. Less and less are using UPS or the United States Postal Service. Amazon never pays a dividend. It's funny, you can own an asset that never pays you anything. The only thing they pay you is when you sell the stock to somebody else, who in turn gets paid when they sell it to somebody else. It's kind of a foreign concept. 100 years ago, people probably wouldn't have bought a stock that didn't pay a dividend. Some people think one or the other. Okay, over the long term, growth stocks are probably going to do well, but during some years, value stocks outperform growth stocks. Some stocks could even fit in both categories, so this isn't mutually exclusive. Volatility, that's a very common investment term. An asset that's volatile can change price very rapidly. So for instance, some stocks like Tesla, for instance, has doubled in price over a few months' time. It's very volatile. And it can also go down. Back around 2000, during the tech bubble, a lot of tech stocks lost 88% of their value in a very short time. You could imagine that. The NASDAQ index lost 88% of its value. Very volatile. Bonds, a little more stable. Bonds can fluctuate in prices, but generally you won't lose 60% of your money in a bond account. So those are some basic terms. If you're interested in following Bogle's approach and just pouring money into the stock market, an S&P 500 is 500 stocks that are a measure of the stock market. If you put it in an S&P 500 account, it will basically, a lot of investors pool their money and they buy these 500 stocks aggregately. Another name is stock index, another name is equity index. Equity is another name for a stock. When you buy a stock, you're buying equity in the company. When you actually own an object, you have equity in it. When you buy a home, if you buy a home for $100,000 and take out a $100,000 mortgage, guess what? The bank really owns the home. As you pay it down, you establish equity in the house. You actually own a portion of the house. So these all mean about the same thing. If you put money in an S&P 500 and money in a stock index, over a long period of time, they'll probably do about the same. Any given year, they may fluctuate. This may return 12%, this may turn 11%. But if you have an option in a 401k, you could choose any of these. But any of these also, keep in mind, an S&P 500 will include growth stocks and value stocks. And an S&P 500 indexed fund will include large cap, mid cap, and small cap. So you're not missing out on anything. You only need to know these terms if you want to specialize, if you want to put more money in large cap or more money in growth stocks, for instance. But for the most part, if you want to follow a simple investment strategy, you don't have to know any of this. So, but it's good to know what it is. This way, when you look at the control panel for your 401k, it's not intimidating. It's not mysterious. It's not something you're missing out on. It's not the latest innovation in investment terminology. Okay, that's all for this. We'll be back shortly for part 3.